And the average investor has to take advantage of that volatility.
Now, volatility is something that does not scare this gentleman. As a matter of fact, he'll look at companies and often does. We're going to have some examples here that you might say, boy, tough time for that company. Things aren't there. You look at it and see opportunity. I want to give you, a year ago on this program, look at these. These sound familiar, Alan Lancz? Qualcomm. And I'm sure the reviewers were saying, Qualcomm, seriously? International paper, Bank of Nova Scotia. Look at those returns. You say, well, we have the overall market was up. Well, with an S&P as a standard at 11.96%. We're talking 48, 48, and 46%. That's just finding what?
Well, it's finding the opportunity. Lesser risk because the expectations were low.
Yeah.
Bank of Nova Scotia, for example, is a great energy play. Energy was down. It's a bank in Canada that has a lot of energy-related assets and loans. So with a high dividend and trading near book value, we didn't think there was a lot of risk and great upside. And those are the type of investments we like for our investors.
Yeah, as a matter of fact, that's something you want to leave all of our viewers with. It's really easy for all of us. I'm sure I've been guilty. You probably have been too. Look at this hot stock over here. We're chasing that latest, shiniest thing. You're saying, look out for those.
Exactly. It happened last year, like the hottest cult stocks, the Teslas and what have you of the world, they were down an average of 35%. And you know, the companies that have the assets that had little expectation and lower risk, you know, did quite well. I see that happening again this year. Give you an example.
Yeah, give me Qualcomm for this year.
Well, first of all, you know, I would say that there are no guarantees. You know, you never know, and we're only going to make, you know, one choice. But, you know, we picked as our favorite investment for 2017, CenturyLink, and it's a company that is trading. You know, the stock was at 28, 29. They announced that they're going to buy Level 3 Communications. I think it's a great fit to help grow that company. They compete against Verizon and AT&T, and they're going to be the third. But with the stock down so much at 22, 23, has a 9% dividend. We think it can appreciate 10%, so it's a great total return. Not guaranteed, not for every investor, but one like Qualcomm, I think there's low expectation in the low 20s.
I do have to ask before we get out of here in time, just goes too fast when we're together. I want to ask you about the Andersons. The announced closure of the general stores kind of took me aback a little bit, yet with some thought it didn't really crush my world. I'm disappointed, but I've heard for years that these retail stores were kind of lost leaders, kind of kept open as a community service. And in the big picture, they're a really small part of the Andersons' agribusiness empire.
Oh, very small. They closed 3 stores, you know, prior to this announcement, so the writing was on the wall. It helps the company long term. Now the stock's gone from 44 year end to 37 ending the week. Okay. You know, but from a long-term perspective, it's positive. The margins are minuscule, you know, in the retail environment. And it was very hard. They had to put a lot of money into it. This way they can focus on you know, the areas that they really make the money. Bad for, you know, the community, but they're such a community leader. I still think they're going to strive for
I have a feeling they will too. That was the face of the Anderson. That's where we saw them as public.
Exactly.
But in terms of rail cars, fertilizer, ethanol, all that stuff, they're huge. They're gargantuan and national. All right, it's going to be an interesting year ahead. We've had my first 2 guests have said so, and I agree with them. So buckle up, and here we go. My thanks to Alan B. Lancz, investment guru, world-class money manager, keeping us on the leading edge of our investment portfolio.